Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Constellation Energy Corporation, or CEG.
And this is a really spectacular deep dive. It puts a spotlight on how a structural scarcity can just completely drive a company's valuation. We're pulling from their Q3 2025 filings, the details of a monumental acquisition and a regulatory landscape that's been reshaped by the Inflation Reduction Act and some subsequent legislation.
Our mission today is to build a detailed, fact-based investment thesis. We want to clarify exactly why this company is trading at such a huge premium.
And it all boils down to this. Constellation is leveraging its irreplaceable nuclear fleet, a fleet operating at a stellar, almost unheard of 96.8% capacity factor, alongside the federally backed nuclear production tax credit, PTC floor, to solve the absolute AI power bottleneck facing every hyperscaler on the planet.
This nuclear AI narrative justifies the premium valuation, but only if they successfully navigate the acute project execution risk associated with the high-stakes Crane Restart project and the immense complexity of the $26.6 billion Calpine integration.
That's the tightrope they're walking. You have this massive generational opportunity from AI demand clashing directly with multi-billion-dollar operational risk.
It's the definition of a high-conviction, high-risk story. So let's start with the foundation, the nuclear core. The numbers here are, well, they're pretty unique in the energy sector.
They really are. CEG is the single largest producer of carbon-free energy in the United States. And that's not a footnote, that's the headline. It's the starting point for any conversation about their value.
Right, because when you hear largest carbon-free producer, your mind immediately goes to what, massive solar arrays or wind farms? But that's not what we're talking about here.
Not at all. Their total generating capacity is around 33 GOBW, which is big. But the real crown jewel is the 22 GWW nuclear fleet. That's 23 active units.
And that's a huge slice of the American pie.
It's almost a quarter, 23% of all U.S. nuclear power. And the financial structure underneath that fleet is what gives them this incredible profitability.
So let's talk about that. A lot of these plants were built decades ago. Why are they so powerful from a financial perspective today? We see the term fully amortized thrown around a lot in the sources.
And that's the key. It means they're essentially running free money machines from a depreciation standpoint.
Right, because the initial cost is already paid off.
Exactly. These plants were built in the 70s and 80s. The massive upfront capital building, the reactor, the containment domes, the whole infrastructure has all been written down. They're fully amortized assets.
Which means their marginal cost per kilowatt is incredibly low.
Extraordinarily low. So if the wholesale price of electricity jumps, even just a little bit, almost every single dollar of that increase flows straight to their bottom line as pure profit.
That's immense operating leverage.
It's the engine of the whole thesis. You have these high-cost, fully depreciated assets meeting a market with a rapidly rising price. In a normal utility, that leverage is dampened because you're always paying off new projects. Here, it's just maximized.
And this low-cost power is meeting a new kind of demand. A demand that needs their unique selling point, which brings us to the reliability premium for AI.
Right. Why is nuclear suddenly the only game in town for the big tech companies, the hyperscalers?
It's a non-negotiable need for uptime.
It is. When you're running these huge AI models, training them for weeks, a sudden power outage, even for a minute, can be catastrophic.
You could lose weeks of compute time, corrupt your data. It's a massive financial loss. So reliability isn't just a preference.
It's an economic mandate. And Constellation's nuclear fleet delivers that better than anyone. That 96.8% capacity factor statistic, it's just astonishing.
Break that down. What does that 96.8% actually mean in practice?
It means the fleet is running, on average, 96.8% of the time. 24 hours a day, 7 days a week. It's as close to a perfect baseload resource as you can get.
And you just can't compare that to renewables.
Not for this purpose.
Yeah.
You contrast that with the best solar or wind farms, their capacity factors rarely get above 45%, maybe 50%. And they only work when the conditions are right. Data centers need continuous industrial-scale power, and CEG's fleet can deliver that carbon-free at a scale no one else can touch.
And the scale of that data center demand is just completely resetting the board. We've heard about EVs for years, but this seems different.
It's a structural dislocation.
Yeah.
The sources we looked at project global data center power demand to grow by a staggering 160% by 2030.
160%.
And the CEO commentary put it in even sharper focus. They expect data center demand growth to be roughly 3 times the total EV demand growth over the next 10 years.
Wow, 3 times. That really frames why they're calling this the AI power bottleneck. Every company in the AI race has to lock down reliable power right now.
And that desperation translates directly into CEG's revenue model,
Right.
which is kind of a dual layer model. You've got premium contracts on the upside and a rock-solid regulatory floor on the downside.
Okay, let's start with the upside. The commercial contracts. This is where the hyperscalers are showing they'll pay whatever it takes for that certainty.
Exactly. You see it in these long-term power purchase agreements, or PPAs. The flagship example is that 20-year PPA with Microsoft for 835 megawatts, which is tied to the crane restart we'll get to.
And they have another big one with Meta.
A similar 20-year deal with Meta for power from their Clinton Clean Energy Center. So they aren't just selling energy, they're selling certainty for the next 2 decades.
And the sources had a really interesting data point on what that certainty is worth.
Yes, the premium is tangible. Analysts noted that hyperscalers were willing to pay as high as 11 cents per kilowatt hour for generation from a 3-mile island unit.
Which is a big step up from the industrial average.
A significant premium. The current U.S. industrial average is around 9 cents per kilowatt hour. So they're basically buying an insurance policy against intermittency and carbon risk.
Okay, so that's the upside. Now let's talk about the foundation, the regulatory floor that protects them if wholesale prices collapse.
It's the genius of the policy environment they operate in. The Inflation Reduction Act, or IRA.
Yeah.
And then it was affirmed by later legislation like the OBBA.
The Omnibus Big Beautiful Bill Act.
Right, signed in July 2025. That legislation established the Nuclear Production Tax Credit, the PTC. And it's essentially a federally backed price guarantee. It creates this economic moat around their existing nuclear plants.
So for anyone listening who doesn't live and breathe tax policy, how does the PTC actually work? How does it create that price floor?
Well, maximum credit is pretty generous, up to $15 per megawatt hour. And it's transferable, which is key. They get the maximum because they meet the prevailing wage requirements.
Yeah.
The goal is just to guarantee a certain level of gross receipts to keep the fleet online.
And it's tied to an inflation-adjusted floor price.
Exactly. For 2025, that floor was about $44.75 per megawatt hour.
So if market prices are high, say $60, CEG doesn't need the subsidy, but if prices suddenly tank to $30 because of, I don't know, a glut of natural gas,
The government steps in, they top up the difference, guaranteeing that CEG still gets an effective price, close to that $44.75.
but it's an economic shield. So no matter how volatile the market gets, their nuclear fleet has this guaranteed stability. That's what bond underwriters love to see.
Predictable cash flow. And under normal conditions, it provides a massive cash benefit, something like $200 million to $300 million in annual cash benefits.
But this is where the Q3 2025 filing had that fascinating detail that really shows the mechanism in action.
It does. We saw that their PTC revenue actually dropped. It dropped significantly.
Yeah, from $670 million in Q3 of 2024 all the way down to $175 million. Now, if you just saw that number cold, you'd think that's a bad sign, a revenue stream drying up.
You would, but it's actually a sign of strength.
So why is the analysis saying that's a good thing for them?
Because the subsidy is designed to shrink as market prices rise. The fact that their PTC revenue dropped by over $400 million tells you that the average wholesale market price was significantly higher than that $44.75 floor.
So they didn't need the subsidy.
They didn't need it because the market was paying them a premium. It's a defensive protection that they don't have to rely on when the market is hot, which gives them full exposure to the upside while keeping that floor beneath them if the market ever collapses. It's really the ultimate financial hedge.
That structural advantage is huge. Low marginal cost, incredible reliability, and a federally protected price floor. That explains the base layer of the valuation. But now we have to move from the base layer to their really aggressive growth strategy.
Right. We're shifting from defense to a very aggressive offense. And you can't talk about that without spending significant time on the $26.6 billion acquisition of Calpine Corporation.
This isn't just a small add-on.
No, this is a transformative, fundamental shift in who Constellation is as a company.
And a deal that size immediately raises flags, especially with the structure cash, stock, and assuming a huge pile of debt.
A massive pile. $12.7 billion in Calpine debt. That's the immediate risk to their balance sheet, to their credit rating.
But the strategic rationale must be pretty compelling to justify that kind of risk.
It is. The combination instantly creates the largest power generator in the United States. It just cements their dominance.
And the main goal seems to be geography, getting nationwide reach. Constellation was always strong in the Midwest, in the PJM grid region, but that's not where all the AI growth is.
Precisely. Calpine is strong exactly where CE is, weak. It gives them instant significant density in the key growth markets where data centers are flocking ERCOT in Texas and California.
So they can now offer genuine coast-to-coast solutions.
That's the pitch. A hyperscaler can come to them and say, we want to build in Chicago, Dallas, or the Bay Area, and Constellation can be their sole power provider.
Okay, so if the nuclear fleet is the reliable baseload, what's the strategic role for Calpine's portfolio? It's mostly natural gas and geothermal, right?
It's the essential hedge against grid instability. Nuclear provides that constant 2047 power, but our grids are becoming more and more dependent on intermittent renewables.
When the wind stops blowing or the sun goes down.
You need something that can fire up fast to manage peak demand and stop blackouts. That is the function of Calpine's dispatchable generation. It adds the flexibility that nuclear just doesn't have.
So nuclear is the battleship, and Calpine is the fleet of fast frigates.
That's a great way to put it. Calpine brings modern, flexible gas plants, but also these huge carbon-free geothermal assets, like the geysers in California.
I've heard of that. It's one of the biggest in the world.
It is. It can power 725,000 homes. These assets stabilize the grid and make sure Constellation can guarantee supply even when renewables don't show up. They can avoid those, $500 per megawatt hour price spikes you see when the grid is under stress.
The sources also mention Calpine's powered land strategy. This seems like a really clever way to get power to customers faster.
It's revolutionary in terms of speed to market. Normally, if you want to build a new data center, getting it connected to the grid can take 5, 6, even 8 years. They're these massive queues.
Right, the interconnection queues are a huge bottleneck.
But Calpine developed this powered land strategy. You see it with their partnership with Cyrusone, developing data centers right next to the Thad Hill Energy Center in Texas.
They're just leveraging the existing power infrastructure, the switch yards, the transmission lines that are already there.
Correct. They've got an initial 190 milliW agreement, and it's expandable up to 400 milliWs. They are completely cutting out the interconnection queue. And that is a huge selling point to a hyperscaler that needs to get online yesterday.
Okay, so the strategic fit is clear. But let's go back to the finances. That $12.7 billion debt load is the big short-term worry. What's the plan to handle that?
The deal is on track to close in Q4 2025. They've already started addressing the regulatory hurdles. They agreed to sell off 6 power plants in PJM and ERCOT to satisfy the DOJ's antitrust concerns.
So they're willing to make concessions to get it done.
Absolutely.
Yeah.
And financially, they've prepared the ground. They renewed and upsized their credit facilities, so the combined company will have a very robust $14 billion of liquidity after the deal closes.
A big cash cushion.
Essential. It supports their existing BBB plus BA1 investment grade rating, and management is dead set on protecting that.
Let's talk about that debt plan. They've set a really aggressive target for getting back to their old credit metrics. That's a huge part of selling this to the market.
They're being incredibly aggressive. They've publicly committed to returning to their pre-deal investment-grade credit metrics by the end of 2027.
So in about 2 years post-closing, they plan to have digested all that debt.
That's the plan. It's a tight window for over $12 billion in debt.
How are they going to pull that off?
It all comes down to the combined company's free cash flow generation. It's supported by the stable nuclear fleet, the PTC floor, and now this new reach into high-growth markets. They're basically saying the combined cash flow is so strong it can rapidly pay down the debt while still funding everything else they need to do.
So the market is betting on their ability to generate cash at a speed that most utilities just can't match.
That's the bet. But if they miss that 2027 target, you can be sure that investor confidence will absolutely crater.
Which brings us right to the core tension of the entire thesis, the execution risk. The best assets in the world don't mean a thing if management can't deliver. And the most dramatic project is the Crane restart.
The Crane Clean Energy Center. That's the new, very aspirational name for what was, until very recently, the shuttered 3 Mile Island Unit 1. The ambition here is just remarkable. They are taking a unit that was decommissioned and spending $1.6 billion to bring it back online.
Wait, you said decommission. I think the sources used the term SAF store. Can you explain that? Because to me, this sounds less like a renovation and more like a resurrection.
It is a bit like that. SAF store is a regulatory term. It means safe storage. The plant stopped operating, but it's essentially been mothballed. The core components are still there, preserved, waiting for eventual demolition.
So it's not like they're starting from a pile of rubble.
Not at all. Because the original containment building, the cooling towers, all that critical infrastructure was preserved. The restart is complex, but it avoids the astronomical cost and the 15-year timeline of building a brand new plant from scratch.
And that $1.6 billion investment isn't speculative. It's directly tied to that massive 20-year PPA with Microsoft.
Exactly. Which gives this project a very strict deadline. It has to be online by 2028.
If they slip, they face penalties.
Penalties, and they potentially lose that premium revenue stream. This makes the Crane project the single biggest operational flashpoint for the stock over the next 3 years.
Are there any financial safeguards to, cushion the risk on a project like this?
Well, the federal government is essentially underwriting it. Constellation secured a huge $1.6 billion guaranteed loan from the DOE, $1 billion of which is a direct loan guarantee.
But that guarantees the financing, not the execution.
Exactly. It doesn't guarantee the engineering, the construction, or the regulatory approvals all go smoothly.
Management's big selling point here is this concept of powered land. What does that really mean for the Crane project?
The sources describe it as an irreplaceable asset. The cost to build new nuclear is just exorbitant, upwards of $12,000 per kilowatt. Restarting Crane is far, far cheaper.
And faster.
And provides a colossal time advantage. The site already has the heavy infrastructure that takes decades to permit and build the cooling towers, the massive transmission lines, the high-capacity switchyards. By reusing all that, they bypass those multi-year interconnection queues and the local battles that cripple new projects.
So they're taking a process that could take a decade and squeezing it into a 3-year window, but only if they execute perfectly.
That is the high-risk, high-reward equation. And their other big growth path is less dramatic, but just as important.
Yeah.
The uprates.
This is just pure operational optimization, right? Squeezing more out of what they already have.
It's optimizing the fully amortized cash cows.
Yeah.
Constellation is planning for an additional 900 to 1,000 megawatts of capacity uprates across their key legacy plants, LaSalle, Limerick, Calvert Cliffs.
And they have a good track record here.
They do. They're already bringing 160 MW online at Byron and Braidwood next year from previous uprates. This is about replacing turbines, installing new components to safely boost output.
That 900 to 1,000 milliW is a lot of new capacity. That's like building a small new gas plant. But pushing these older plants harder must introduce new risks.
It absolutely does. And the operational risk is all about downtime. To do these large-scale uprates, they need extended refueling outages in 2026.
And these outages are planned years in advance. They're a very delicate dance.
Very. They only shut down for refueling every 18 to 24 months. If the uprate work causes those outages to run long, even by a couple of weeks, it directly hits their capacity factor.
And hits their revenue.
Exactly. That near-perfect 96.8% capacity factor is the bedrock of their premium valuation. If they start having repeated extended outages in 2026 because of engineering problems or supply chain issues, they immediately damage the reliability premium they're selling to the market.
So let's just synthesize the pressure on the executive team here. They're juggling 3 mega projects at the same time.
It's a corporate hat trick. First, you have the $1.6 billion Crane restart, resurrecting a retired plant on a tight deadline.
Second, the massive, complex $26.6 billion Calpine integration, merging 2 different cultures, 2 different asset types across completely different regulatory markets like Texas and California.
And third, the extensive fleet uprates across their legacy plants, which require pinpoint management of those critical 2026 refueling outages.
It's an immense bet on the competence of the management team. The CEO, Joe Dominguez, the new CFO, Dan Eggers. The entire market premium is basically riding on their ability to execute.
If operational excellence falters in any one of those 3 areas, the stock is going to see a very severe correction.
Okay, so let's look at the external factors, the tailwinds. There's a really favorable policy environment that gives them a valuable moat.
It's ironclad and is bipartisan. We already established that the nuclear PTC was a huge win for them, extended by the OBBA in 2025. That tax credit alone is a permanent economic floor.
And the support isn't just from Congress.
No, the executive branch is also fully aligned. In May of 2025, President Trump signed executive orders with an incredibly ambitious goal to quadruple domestic nuclear production within 25 years.
Now, that goal seems aspirational.
Highly. Analysts agree that new nuclear is still too slow and too expensive to hit that target, but the political signal to the market is crystal clear. The government wants nuclear power to win.
And those orders also targeted the big regulatory bottleneck that's held the industry back for so long.
Correct. The orders mandated regulatory streamlining, a reorganization of the Nuclear Regulatory Commission, the NRC, and critically, they set a tight 18-month deadline for reviewing new nuclear project applications.
Which used to take years.
Years, burning through hundreds of millions in costs before you even broke ground. So this push to accelerate things benefits CEG by validating their assets and maybe even speeding up future relicensing approvals.
Now, moving beyond just making electricity, they're looking to monetize their excess power through what's called sector coupling, specifically hydrogen.
This is a major future growth area. They're actively looking to create clean hydrogen, often right at the nuclear plant, using excess power that would otherwise be sold for cheap on the wholesale market.
And the demand for clean hydrogen is huge, especially for heavy industry.
Immense. Remember, 83% of heavy industry still runs on fossil fuels. They need clean, industrial-scale hydrogen to decarbonize.
It sounds like a perfect synergy. But this is where the biggest binary regulatory risk comes in, isn't it?
This is a huge binary risk. The entire value of this hydrogen plan hinges on the final rules for federal tax credits. As it stands, the existing Treasury rules do not permit existing nuclear to participate in making hydrogen that's eligible for the most lucrative credits.
And that's because of something called the additionality requirement. Can you explain that?
In short, the government wants to subsidize new clean energy production. They don't want to just subsidize shifting existing clean power from the grid to making hydrogen. So they want to see new wind, new solar, or new nuclear built specifically for hydrogen.
And since CEG's fleet already exists,
The initial Treasury proposal excluded them. So until the final rules are issued, which is expected after the election, this massive potential revenue stream is either completely unlocked, creating billions in new value, or it stays permanently capped.
it's an instant re-rating event for the stock one way or the other.
Absolutely. The difference between a nice side business and a massive new profit center.
And they're also looking at other fuels, like sustainable aviation fuel, SF.
This is even more innovative. They got a DOE grant to develop a membrane system that can literally scrape CO2 from the air using their cooling towers. That captured CO2, combined with their clean hydrogen, can be synthesized into ethanol or methanol and then converted into sustainable aviation fuel. It's a very clever way to use that seasonal overproduction of clean energy to create high-value, hard-to-decarbonize fuels.
And we should briefly touch on their hydro assets. They provide a lot of long-term stability that flies under the radar.
For sure. The successful settlement in September 2025 for the 50-year relicensing of the Conowingo hydroelectric project was a huge win. That's 572 million MW of generation.
And relicensing hydro is notoriously difficult.
Very complex, environmental issues, water quality.
Yeah.
But they locked that asset in for 5 decades at a predictable low cost of just $15 to $20 million a year. It's just another layer of long-term secure cash flow for them.
Okay, we've built the bull case. Irreplaceable assets, federal price floors, massive AI demand, the Calpine expansion, future growth in hydrogen. Now we have to tackle the valuation. This stock trades at a scarcity premium.
It does. And this is where you have to be careful. Constellation is not valued like a normal utility. The stock's forward price-to-earnings ratio is somewhere between 39 and 42 times.
That's roughly double the sector median.
Easily. The market is pricing in near-perfect execution and guaranteed aggressive growth.
So what is management promising to deliver to justify trading at 40 times earnings?
They're forecasting a very ambitious 13% compound base EPS growth target through 2030, and that growth is supported by locked-in contracts, the inflation adjustment on the PTC floor, and the earnings from the uprates. Analysts seem to think that 13% target is credible as long as they don't have any major operational disasters.
But the real driver of that premium isn't just the 13% growth. It's that explosive, nonlinear financial leverage we talked about earlier. Let's revisit the power of that fully depreciated fleet.
This is a metric that justifies the valuation. The nuclear fleet generates about 165 billion kilowatt hours a year. And because the cost structure is so low and stable, if the average wholesale price for electricity goes up by just a single 1 cent,
Just 1 penny. From, say, 9 cents to 10 cents per kilowatt.
that single cent generates an estimated $1.65 billion in incremental nuclear revenue.
And because of that operational leverage, most of that $1.65 billion flows directly to the bottom line as profit.
It's transformative. A relatively small, sustained price increase in the power market, driven by AI demand, can instantly lift their earnings by billions of dollars.
The stock's PE is the market paying for the option on that single cent of price increase.
That's it. But the flip side is that a high valuation leaves zero room for error. Let's lay out the three big structural risks that threaten this whole story.
Okay, risk number one.
The primary, most immediate threat is project execution. The entire thesis depends on management delivering those multi-billion-dollar projects. Crane, the Calpine integration, the 2026 uprates on time and on budget. Any delays, any stumbles, and the market will punish them.
So that's operational risk. What about the policy risk? You mentioned that binary outcome on hydrogen.
That's the policy dependence risk.
Yeah.
The Treasury rules on the hydrogen tax credits are a true binary outcome. If they get excluded, a massive projected revenue stream is just capped. And while nuclear support is bipartisan now, political priorities can always shift. The PTC floor seems safe, but it's always a background risk.
And finally, the long-term risk of how they use their capital. They have this golden goose, the low-cost existing fleet. They can't risk that advantage.
That's the capital allocation risk. The premium is rooted in that low-cost structure. If management gets caught up in the AI hype and pivots too aggressively towards building brand new nuclear capacity at $12,000 a kilowatt, they will crush their profits for years.
They'd be swapping guaranteed low-cost profit for high-cost, speculative, slow growth.
Exactly. Investors want them to focus on relicensing and uprates, not massive new construction projects.
So the final synthesis. Is the scarcity premium justified? Should you, the listener, accept these risks? The market is right to see Constellation as a unique asset. The combination of irreplaceable, 247 carbon-free power, a federally protected price floor, and this undeniable AI demand. It creates a competitive advantage that no one else in the sector can replicate at this moment.
So to invest, you have to be buying into the execution story.
You're buying the management team. If they deliver on Crane, smoothly integrate Calpine, and maintain operational excellence through 2026, then that 13% EPS growth, plus the potential billion-dollar multiplier from rising power prices, absolutely justifies accepting the risk.
But if they stumble?
If they stumble, CEG gets immediately reclassified. It goes from a high-growth AI proxy back to being just a complex utility with project risk. And the correction will be fast and painful.
That's a very clear articulation of the trade-off. We've seen throughout this that the fundamental way we consume power is shifting. We noted that the base load of U.S. electricity, especially at night, has grown rapidly. The difference between daytime and nighttime power use has narrowed from 43% in 2019 to only about 30% today. So given that data centers run 247, but solar only runs during the day, how does this change the whole economic structure of the grid? Are we on the verge of a future where the night tariff could actually overtake the daytime tariff?
That is a profound observation, and it highlights exactly why CEG's assets are so necessary. Historically, daytime power was always more expensive, industrial demand ramping up peaker plants. But if a huge chunk of your demand is now running nonstop, driven by AI, and solar provides cheap but intermittent daytime power,
then that stability at night from nuclear and dispatchable gas becomes exponentially more valuable.
Exactly. The cost of keeping those dispatchable gas plants, like the ones Calpine has, ready to manage that 7 p.m. peak when the sun goes down, that's what's going to drive the night tariff up. You're suggesting the premium for CEG isn't just about the volume of power, but the timing of that guaranteed 247 supply.
It challenges the whole traditional model of the grid.
It does. And that fundamental shift is exactly why the market is paying such a scarcity premium for non-intermittent power.
Something to mull over until our next deep dive.
Risk defined. Portfolio protected.